So we're absolutely delighted to have Benj Gallander here with us today. Benj Gallander is the president and a co-editor of the Contra the Herd investment letter, an investment letter with a contrarian approach that has had a remarkable 18.1% annualized return over the past 20 years. Benj Gallander is on the boards of Datametrics AI Limited and Char Technologies. He also authored 3 best-selling books, The Uncommon Investor, The Contrarian's 13, and The Small Business Survival Guide. Mr. Gallander is also renowned for his column in Canada's national newspaper, The Globe and Mail, which features his contrarian take on stocks and broader issues for investors. Thank you for joining us today, Mr. Gallander.
Oh, it's a pleasure. I've spoken at many universities in Canada, but this is actually the first one for me in the States. I've done numerous presentations in the States in many different places, but finally I'm making the university circuit. Hopefully it's the first of many.
Sounds excellent. So why don't we start by diving into your presentation?
Okay, well, we've been around for a long time. We've been doing the investment letter for 27 years. It is contrarian. Our results are amongst the best out there. Last year, the return was 41%. If I'd been a little smarter, it would have been that much higher. The 10-year annualized return is 19.1, and you mentioned the 20-year return. I mean, we're very proud of how well we've done. We have a lot of followers because of it, a lot of people who subscribe to the letter, and hopefully our future returns can be as good as the past returns. We'll have to wait and see what happens there. Let me just switch to the next slide. So Benj Gallander is widely considered the foremost authority on contrarian investing. So that's by the Globe and Mail. Again, it's the newspaper I write for, but they did it a long time ago. You know, it's wonderful. We've actually tried to get more traction in the United States, and we've been very unsuccessful at doing it. As I've spoken, we have some US subscribers, but I've never had a US newspaper do an article on us. Have been in some of them, but only minor league way. National Post, if all of the world's a stage, then Benj is one of the market's greatest characters. And I think that's because I started one of Canada's largest theatre festivals, Summer Works, with a friend of mine. It's in its 31st year. There's a magazine called the Canadian Theatre Review, and they actually had a whole issue on that this past summer. Also, 6 of my plays have reached the stage. So I'm proud of that. A moderate success. I wouldn't say I've had big success. No Broadway for me, but it's been very cool. And Market Masters, a book that became a bestseller in Canada, they chose 28 investors of Canada's top investors, and they had me up at number 1 on the list. So, you know, that felt good. I've got an ego too, I confess. Anyhow, we'll see what happens again in the future. So, quote, I will tell you how to become rich, close the door, be fearful when others are greedy, be greedy when others are fearful. It's by a guy named Warren Buffett. If any of you get a chance, you might want to go to Omaha first weekend in May for the Berkshire Hathaway meeting. I went a number of years ago. I'm planning to go with my sons. I'd been thinking of going for a number of years. I ended up going with my business partner. I talked about it with one of our subscribers and said, you know, Warren's not getting any younger. And he said, Charlie Munger, his partner, he was getting older too, was about 87 at the time. So I decided to just go. And I said to Ben, if you want to go with me, that's great. Otherwise, I'll go on my own. And the next day when we were together, he said, yeah, I want to go. And I said, why did you decide so quickly? And he said, well, Benj, we're not getting any younger either. And I remember when I presented at the University of Western Ontario, one of my 4 alma maters, you know, when I was speaking, I was saying to the students, I told them how much I traveled, etc. And one of them got back to me years later and said how meaningful it was to him. He's done a lot of traveling. I mean, work is a great thing, but at the same time, it's important that you do other things and focus on other things and enjoy your life because you just don't know how long you have. George Soros, it's not whether you're right or wrong it's important. It's how much money you make when you're right and how much you lose when you're wrong. He's one of the world's greatest investors. I went a number of years ago to Hungary. I followed in his footsteps a little bit. It was wonderful to do. So we concentrate on turnaround situations and stocks which are currently unpopular, but are likely to regain their luster. So the first filter that I use is I look for stocks that are down at least 50% in the past year. Then I look to see if they've been around for 10 years. And this is so much easier. When I started investing about 45 years ago, it's hard to believe I've been around that long. I had to actually go over each stock in the newspaper and look at the 52-week high, 52-week low, and just go line by line. It was completely different. Then to get information from the companies, some of it I contacted them. I mail an envelope to them and ask for information. I would also go to a broker I knew and look at their value line, but it's all changed because of the internet and all the information you can get. And it's just such a fantastic tool. I focus on stocks that have the ability to increase in value by a minimum of 50%. Usually it's 100%. I'm always looking to hit home runs and grand slams, but none of it is based on just possibility without a history. I'm always targeting the stock to end up where it has been for numerous years in the past. And so say if a stock's traded 200% higher for 7 of the past 10 years, I could be looking around there as my initial sell target. If it's spiked, say 3 times in the past 10 years, I could do that. The thing is I always set a sell target, and I do that before I bought the stock. So that helps to ground me. So none of it's pie in the sky. I don't want to blow in the breezes. So as I mentioned before, things like the internet are wonderful tools, but there's a problem. We're so bombarded with information today, whether it be from your cell phone, from the internet, from other sources, that it makes people change their minds more. And often there's 3 decision parameters. A lot of people don't think this way. There's the buy parameter, the sell parameter, and I'm not going to do anything parameter. And people don't think of I'm not going to do anything as a decision, but it is a very viable decision. So it's very, very important that you think that way and don't blow with the breezes of the internet. Don't follow your friends just because your friends say something. Make sure you do research. So how do we do the research? We carefully analyze corporations' financial statements, concentrating on debt ratios and book values. So all of this information you can get quite easily. I often use Yahoo, I'll use Morningstar, I'll use some other things. I used to buy companies sometimes with too much debt. Debt can be a huge problem. Debt is what gets corporations, it's what gets people, it's what gets countries in trouble. So I look to avoid debt. Corporations I'll buy may have some debt, but I try and limit it. I was just reading about this whole MMM idea, that it doesn't matter how big a deficit or how big debts countries have, because they can just print more money. That's my way of thinking, is hogwash. It's very important how much debt and deficits countries have. The US right now is getting themselves in a tougher situation because they've been taking on so much debt. Canada too, the country where I live, it's taken on tremendous debt, a lot of it, of course, because of the pandemic, but we're getting in a more dangerous situation. So you got to watch some of these new philosophies they come up at you with, and some of them are hogwash. They're just not true. As a matter of fact, the woman who's primarily behind this was saying that all of the amount of money being printed wouldn't cause inflation. Well, we're seeing inflation now She's since backtracked on that to some degree. Another theory I don't believe in, that I argued with one of my university professors about, efficient market hypothesis, which says basically you can't make money from stocks unless you have inside information. My professor argued that all the information was out there, so everybody had it. Well, there's information out there. The question is then, do people see it? And then how do they use it? So it's a completely different thing. So efficient market to me makes no sense. We've had tremendous returns for many, many years. Warren Buffett has, who I mentioned before. So I simply don't believe it. One of the things I've learned over the years is to make sure you're cynical. I don't mean to live life in a very cynical way, but when you're investing, you have to have some cynicism. I consider myself to be an optimistic realist. So I'm optimistic about things, but also realistic about things. I don't know why my nose is itchy. And I think it's important to be optimistic, but also realistic. I wouldn't want to lead my life in a pessimistic vein. Your university students, you've got your whole futures away from you. I'm actually a bit jealous. I wish I could go back. I haven't found a way to do that yet. If somebody finds a machine where I can do it, please let me know. Next. We analyze management's abilities to achieve stated goals. And I have to get the right page. Still have to get the right page. I'll just go with what I got. To achieve stated goals. So this is very important. What I like to do is look at the management's reports in the annual report, see what they said. If they said we're going to have good years the next 2 years and they don't, well, I'm skeptical. If they're realistic enough to say we're going to have bad years and then they do, that to me makes more sense. There's a certain amount of credibility with management. I think it's very important. I only invest in corporations that have existed for at least 10 years. And to me, that's very, very important. I like to see a track record. And this way, I'm not investing in anything newfangled, anything that's just come out. So I will miss it. Back in the late 1999s, when they had the tech bubble that some of you might have heard of, I wasn't buying tech stocks except one, Itai, which had been around for a while. In terms of marijuana stocks, I missed that. In terms of cryptocurrencies, I've missed that. But after 10 years, I can buy into some of those things. I'm not buying into things that are hot. I'm buying into things that are cold. And what I like to do is see them become hot, turn around, and then when the party's in full swing, I like to sell. So I'm always looking to buy stocks under $10. The odd time I will buy over $10. Often I buy stocks for $1, $2, $3. What happens when they get over $5, that allows more institutions and brokerage firms, etc., to buy in. Over $10, even more. So what I love is when I buy a stock and later on it moves up more in one day than I paid for it. I mean, the best example I have, I guess, is when I bought they do earphones. And I bought them under $2. Eventually it went up to $127. Unfortunately, I didn't hold it all the way up, but still did pretty good. We often pick takeover candidates well before takeovers occurs for near optimal results. Takeovers are almost always done at premium. So if I can buy a company that I think will get taken over, I've got a better chance of doing well. So sometimes it's rumored that a company is going to be taken over. So in the point tally system that I talk about in my books, I put in a point for that kind of thing. So again, often there's a premium of 10%, 25, 50%, whatever. And that's the way to get good returns. In the 27 years we've been in existence, we've had takeovers in 25 of those years, and that's in a portfolio normally is 15 to 25 stocks. We've since started a second portfolio, but statistically, we're off the charts with that. Normally sell a minimum of 50% of a stock upon achievement of our target, while market timing the remainder. So we set, as I said, initial sell target. We'll almost always stick with selling some of it around the sell price. There's exceptions. In November, December, I won't do it. If it's a big gainer, I want to defer taxes for a year, so I'll wait till the next year to sell. Sometimes I'll sell the whole thing, but we're very grounded, very disciplined. If you want to do well in stocks, you have to be. And there's so many systems to invest. Ours is just one system, but it combines many other systems. So that's key. If you find a system that works for you, that's great. That's the key thing. Not used to talking so much, I have to drink. We practice patient investing while ignoring the daily pulse of the market. So again, with all of the stimuli being thrown at you now, it's much more difficult to be patient. I was a regular on BNN, which is a business news network. It's also Bloomberg since pretty much the beginning. And one of the people who interviewed me, Mark Bunting, always asked how I could be so patient. Well, part of that is, setting yourself apart from the market to some degree. Part of it is not watching markets all the time. I do look at them every day. I spend too much time on them every day, I think, even then. But you have to avoid the daily pulse to some degree. Advocate diversification. The portfolio I manage has 15 to 25 stocks. I think that's enough to have a diversified portfolio. In one of my books, a chapter's called Avoid the Devil of Over-Diversification. If you're buying mutual funds or ETFs with 60 or 100 stocks, the more stocks that you have, the harder it is to do well at a certain point. But you want to be diversified enough that you're not killed if a few of your stocks get killed. So you have to watch it. There's some people who buy all kinds of mutual funds or ETFs, and they counterbalance each other. They work against each other. So diversify, but don't over-diversify. It can be hard to find that balance. Some people say you only need 6 stocks. I think at least 10, but again, I go 15 to 25. You also always have to think, what are your costs? Mutual funds have higher costs than ETFs. So if you're paying 2% a year, then if you have, and I'll say 100,000 invested, which you students won't, but that's going to cost you $2,000 a year. Whether you make money or lose money, they're going to go into your pocket and take those funds. If you buy 15 stocks, you pay $10 a trade, or you can even pay 0 a trade. So if you pay $10 a trade, that's $150 when you go in. If you don't trade a lot, you might have no fees, or very low fees. So you've just saved yourself an awful lot of money. So I'm a great believer that it's better to invest yourself than in mutual funds or ETFs. Again, you have to be very concerned about the expense ratios. I appreciate stocks pay regular dividends. About half the stocks I have in my portfolio, they do pay dividends. I sometimes say dividends allow me to be stupid longer. What that means is if my stock isn't doing well or going down, which they often do, if I'm holding on to it and getting a dividend, at least I'm getting some sort of return. So I'll give you a couple examples. The 2 biggest funeral home operators in the United States used to be Service Corps and Stewart Enterprises, number 1 and number 2. For years after I held them, 3-4 years, they did nothing. Actually, Service, I think it was, they actually went down. because they found that they were moving some bodies and putting new bodies in. Well, you can't just remove the old bodies. I was getting a dividend, though, for a number of years, but then the stock started to fly. After 7, 8 years, they ended up going up over, I guess, about 400% each. So if you hold a stock for 10 years and you have a gain of over 400%, that's a huge, huge gain. It's also incredibly tax efficient. Add on top of that the dividends, which in Canada, and I believe in the States, they're taxed at a preferential rate, so you don't have to pay as much. So dividends are key if you can get them. I like them. Wow, I couldn't have gone through everything already. Yeah, I guess those are the key things. So here are my 3 best-selling books. The Contrarian Investors 13 did come out in both Canada and the States. The reason it's called Contrarian Investors 13 is because there's 13 rules in the book. And 13, of course, is considered to be an unlucky number by many people. So each chapter is about one of those rules. I actually had the Black Swan on the book before that other guy became famous for it, but he's also, I think, a pretty bright fellow. The Uncommon Investor 3, How to Earn Superior Returns in the Stock Market Despite Everything. And then there's another book, the Uncommon Investor it started with, and it talks about stocks and baseball. So I use an awful lot of baseball metaphors in terms of investing in the stock markets. So it's absolutely, for me, I love baseball. I played a lot of baseball. Unfortunately, I had to stop because of the pandemic. I don't know if I'm going to go back. I'm proud of my last season. I was the oldest player in the league, playing in a league with almost all 20s and 30-somethings, and I was still okay. The other book is basically about how to start a small business and operate it. There's also a US edition of that book. There's a Chinese edition. I couldn't understand it. There was a Czech edition that they bought the rights for when I worked in Czechoslovakia. So that book has done very well. It came out in the late 80s. I did some other editions along the way. So I'm proud of those books. I've done a lot of writing over the years, and keep on going. So I still write for the Globe and Mail. I write for some publications in the States, talk about some of the companies there. I often speak at different events in the States. The Money Show is a regular, and I've spoken there in New York and Orlando. I spoke at Cambridge Resource. They have one in Palm Springs. So I try to get to the States quite a bit. I haven't in the past couple of years, again, because of the pandemic, but I'm looking at the time when it will happen again. You can see here, there's different ways to follow us. You can go to our website and get more information there. My email address is there, gall@pathcom.com, the phone number. I have a Twitter handle. I post maybe once a day. I'm not a big poster. And we also have it at Contra the Herd. So there's a lot of ways to get to me. If you have questions after the presentation, that aren't answered in the questions coming up, by all means, feel free to contact me. And if any of you are interested in subscribing, you can do that via the website. I doubt for most of you, you want to do it because it's costly for a student. It's $680 a year. But if you send me an email, maybe we can work something out for student discount, just because I may be in a good mood that way. So should we open it up for questions, or where do we
Exactly. Yeah. First of all, thank you for the presentation. It was excellent. And that's a very, very generous offer by you at the end. What was that earphone company you were talking about? What is it called?
Company?
The earphone company?
Oh, Cost. Yeah,
yes.
Cost has been around.
Can you talk a little bit about how you found that investment in your thesis on it?
Yeah, basically, it followed the same filter that I followed for years, and it had traded at much higher levels. And I just thought, okay, well, this seems like a good investment. So I bought it. It said dollar and change. I never expected it to do what it did. The initial sell target was 7 and change. It got caught in a positive way within the memes. So when the memes were going a year ago now, it became one of the meme stocks, as did BlackBerry, another of our position that we sold for a lovely gain. Held back some. I wish we'd sold it all. But it was the same research we always do, but it was really an exception. I mean, the stocks we buy don't go up, 150 times. It doesn't happen. I've had some 10 baggers in my career, which means stocks going up 10 times. And as I mentioned before, we're always looking for 3, 4, 5 baggers. But that was an absolute crazy thing. It's been interesting because, quite frankly, before it happened, I knew nothing about meme stocks. And then all of a sudden, meme stocks became popular because of Reddit and Wall Street Bets. So what did I do? I sat down and did research on meme stocks. So now I think, could a stock that I buy become a meme stock? It's very small in terms of why I buy a stock, but it's a consideration. And certainly I look, if some of my stocks go crazy at some point, well, has it become a meme stock? Does it have much more upside because of it? But it was a unique situation that wouldn't have happened 5 years ago or 10 or 20 years ago. So it's important as an investor that you do stay up with technology and you do stay up with changes, but it's important you don't get sucked into that technology too. And there's a fine line there. Talking about returns, this just popped in my head. We're talking about managed expense ratios and things. I was just at a Grey Cup dinner, which is our version of the Super Bowl. Not quite as big in Canada. And the guy who puts it on is a hedge fund guy. And hedge funds often take 20 or 30% of the gains and 1, 2, or 3% otherwise. So you have to watch in this game people who are being greedy and are more concerned. They want you to make money, but more concerned about their own pocketbooks. Going back to the question again, we had another stock that was not to the same extreme, but called Alpha Pro Tech. And whenever there is a plague in the news, be it the pandemic we have now, or SARS or Ebola, that stock would fly. They have 2 divisions. One of the divisions does things like gowns, protective shoes, that kind of thing, which become very, very much in demand during a pandemic, face masks, etc. The other part of their business is building supplies. So it seems almost every time there's a potential pandemic in the news, that company goes up like crazy. So it's another one. We bought it under $1, and then it shot up to over $20, which is a pretty good return. Again, I didn't hold it as long as perhaps I should have. But if a company has never done anything like this before, it's difficult to base a model on it. And I think right now we're in a dangerous situation because so much of future expenditures are being based on the pandemic. We have not had anything like this since the Spanish flu going back to about 1918. So if you're going to build systems based on something that happens every 100 years, that's going to prove very wasteful and unfortunate. So we have to watch again, we don't get sucked into that. Maybe that's my expression of the day, sucked into it, that amount of spending, and prepare for something that so rarely happens. One of my stats professors, he used to put crazy theories on the board and fill it up and look at our glazed over eyes and say, "You having fun yet?" Well, this pandemic has not been for sure a fun time. I thought I'd throw it in.
Yeah, absolutely. And another thing you mentioned is that a lot of times one of your things that you look for is companies that are takeover targets. What sort of signifies to you that a company is a takeover target?
Well, sometimes it's known, it's mentioned in the press that, so I'll give you an example. There's a company here called Rona. They're in the hardware business, like Home Depot in the States, but smaller. And they had been rebuffed. The company, it was Lowe's actually, said they wanted to take them over, and the Quebec government said no, Quebec-based company. So I thought, well, maybe later on, the government will be more willing to allow it to happen. So in that case, I bought the preferred shares at $16, $17. Most preferred shares, as you know, they come out at around $25. So they were paying when they came out, I don't remember exactly, but we'll call it 6 or 7%. But because I bought them at a third less, I was getting a dividend more like 10, 11, 12%. When the takeover was announced, they agreed to buy the preferreds at $24. So I had a bit less than a 50% gain because I paid a bit more than 16. Plus, I've been getting a great dividend. But often it's in the news a little bit that, or another way is a company says we're looking at strategic alternatives. That often means they're looking at being taken over. Now, what often happens when that's announced is the stock price may jump. But if nothing happens for 3, 6, 9, 12 months, often people forget about it. And the stock price goes down. Well, that may make it worthwhile. Again, in my model that's in my book, my point tally system, I will say, okay, I'll look at it again and say, well, maybe they're still looking at those alternatives. Maybe it still hasn't happened yet. Maybe it's gone off the rails. Often companies say, we've stopped looking. But often they're still looking, they're still trying, it just hasn't happened.
Yeah, absolutely. And so one of your main themes is your contrarian approach. I think two very sort of contrarian things today would be one, investing in Russia, and another is investing in especially the private education sector in China. Do either of those seem appealing to you today? And if so, are you concerned at all about delisting risks?
Well, I bought into a company not so long ago. It was last year, called Mobile Telesystems. It's a Russian company. It's the biggest company in that sphere in Russia. So they're into the internet, they're into television, they're into banking, they're into all kinds of things. The stock price recently took a hit because of what's going on between Russia and the Ukraine. And whenever you invest in a company like that, you have to be wary of geopolitical risk. So whenever we buy a company, we send out an email saying, this is what we bought, this is the price we paid, this is our target price, this is why we like it, and this is why we don't like it. So for that company, geopolitical risk was key. But we also know they operate in some other countries, not necessarily the cream of the crop. It also pays a beautiful dividend. Now, many European companies do not pay dividends like US and Canadian companies, that roughly the same dividend every quarter. Often there they pay maybe 4 times a year, maybe twice a year, but it can vary quite a bit in this quarter. And this company does that. But it seems to work out to about 8% a year. If you're investing in foreign countries, you have to watch about the clawback, though, because the countries themselves may claw back the dividend that you're getting paid. So that can be a big thing. In terms of China, I own China Automotive Systems. Pretty big company, big in car manufacturing, getting into EVs. Again, the major risk there is geopolitical risk. It's something I assessed. China certainly has a different way of looking at things. I think they're, doing a phenomenal economic job. Where they've come in the past 10, 20 years is amazing. The way that they're taking over the world to some degree is phenomenal. And of course, there's a wariness about it, and I think there has to be. We literally bought a Volvo 2 weeks ago, and I just thought, great, we got a fabulous Swedish car. I didn't know until somebody sent me an email the other day. They're now owned by a Chinese company. China has invested in so many countries, and in infrastructure, in 5G now, et cetera, and of course has been pushed back. So you have to be wary, but the US really depends on China for a lot. China owes an incredible amount of US debt. If the US ever has push come to shove, the Chinese could say, well, we're just going to sell off some of our American debt. So there's a danger there. So danger's both ways. So yeah, you have to think, where are you investing? We also own Orange, which used to be called French Telecom, based in France. Now there are many, many countries. So we try and diversify through other countries at the same time.
Absolutely, that makes a lot of sense. And people are wondering, what are your thoughts on, are there any metals that look attractive to you today? People brought up maybe like uranium or copper or lithium or maybe any other thing that you think is an attractive metal today.
Yeah, we own Cameco. It's a Canadian company. I believe normally the biggest uranium producer in the world, or number two, along with a company in Kazakhstan. They're not producing right now for the most part because the price of uranium went down so much, but they're still making money. It's fascinating when you look at nuclear technology, because every once in a while we have a nuclear blowout. We had General Public Utilities in the States, in Pennsylvania, years ago. Right after that happened, I actually bought into the company and did quite well on it. You've had what happened in Japan just a few years ago. So the Japanese have phased out a lot of their nuclear, although they seem to be going back to it. Chernobyl was a big one. If you haven't seen the series called Chernobyl, it's a fabulous TV series. China, of course, is doing more nuclear. You're getting a lot of talk about these small nuclear reactors. I also own a company called GVP. It's in the States, and they train people for nuclear. They also do other training too, but they're big into nuclear training. Company trades right around where I bought it. It really hasn't done anything since we bought it, but I like that one. Good balance sheet. I think it has a lot of potential. In terms of other commodities, major investments that I've made are in gold. So one I just bought not so long ago is Yamana. Worth looking at. They just reported again today their mine life at the 5 mines keeps on getting longer. That's absolutely critical. Their all-in sustaining cost is fairly low. They pay a dividend. Did I say that dividends allow me to be stupid longer? Oh, yeah. So you might want to look at that one. It's a beautifully run company, a lot of potential. I perceive it could easily do more than a double. I also own Goro. It's a company out of the States. Their holdings right now are in Mexico, although they just bought Aquila Resources, which is based in Michigan, but they have to develop that mine. The CEO has a great track record. The company also pays a dividend, but I think it has a lot of upside. And I own a small one called Urbana. It's a real mini company. It trades at about 31 cents, but has 2 operating mines, one in Spain and one in Bolivia. And it has a number of years of mine life ahead of it. The stock price often goes up with the gold price. I mean, all gold companies do to some degree. But this one I think is a little more dependent. Of course, they go down with it. And these companies also spin off some other commodities at the same time. So those are a few of my favorites in the gold patch and the commodity patch.
Absolutely. And what about the oil and gas sector? How are you viewing that today? And are there any companies that look interesting to you in that sector?
Yeah, we've got, I guess, some of my major investments are in oil and gas. One that's fascinating right now is Northern European Royalty Trust, NRT. We bought it at 6 and change. It went down to 2 and change. It's just skied up to 13 and change. I think it has more upside. Being a royalty trust, it has no debt. It basically has ExxonMobil and Royal Dutch in Germany. They have gas fields there, and they do all the work. They do all the drilling. They have all the risk. And NRT simply gets a dividend from them and distributes it to people like us. The dividend this past quarter was a quarter, so it's been going up again because natural gas and oil prices have gone up. I mean, this is also another play on Russia to Ukraine. If Russia invades Ukraine, I suspect that this company will jump again in price. Natural gas prices in Europe have gone up quite a bit, as they have here, and oil prices. So I think that's a good play. Let me just check Contra, because I think there's one other that I'm thinking of. But the name is momentarily eluding me. Yeah, Black Diamond. It's a Canadian company, and they actually do like mobile housing. So they had a lot of housing up in the Northwest Territories, in Canada. So when companies are going drilling, they have the people stay there, but they're also involved in education. So say they'll have portables for education. In answer to your question earlier too, China and education, I don't have any investments in education in China right now. Black Diamond I like a lot. They've reinstituted their dividend. I think it can do a triple from where it's at now. It was another company that did nothing after we bought it, no dividend, and then it started to gain traction. And one other I'll throw into the mix is Enerflex. They're into pipelines and things. It's another Canadian company, beautifully managed. They just did a takeover of a company called Intera. And you have to watch when a company does a takeover of a big company, often there can be problems because it leads to all kinds of write-downs. So their stock went way down right away, about 15%. Since then, though, it's gone back up quite a bit. So oil and gas is particularly interesting. I mean, a few years ago, not so long ago, the price of oil became negative, which I'd never seen in my life. You had people playing with it to some degree, but barrel of oil was down about $30 for a period of time. Now it's up to around $90 again. So it's unbelievable how it moves. Some people are predicting $100. To predict $100 now isn't very meaningful because that's only about a 10% gain. If you had said that when it was $30, it was meaningful. If you said $150 now, it's meaningful. I don't really know where oil and gas is going to go from this point in time. Overall, though, they're the biggest holdings in the portfolio. A few years ago, when the U.S. was having a banking fiasco, all kinds of difficulties, we bought into a lot of U.S. banking stocks. They were the biggest holdings. And I bought into Bank of America at $6 and change. I finished selling at about 38. Last I looked, it was over 45. Bought into Fidelity Southern at $3 and change, sold over $20. We still hold two. There were a number of others I held in too. Funk, First United, which has been moving up smartly. They just reported great earnings. I think there's more upside, nice dividend. And the only one that's been a laggard is FUSB, F-U-S-B. It's First U.S. Bancorp. So I think we bought it at 8 and change. It's at about 10 and change. I think it can double, but it simply hasn't done well. It pays a small dividend. It used to pay a much higher dividend. But I mean, that's kind of how we look at things. When a sector is really beaten down, that's a point in my system. unless you think it's going to go to the dinosaurs and be eliminated like slide rules or like horse and buggies, if you think the sector will come back, then the key is to choose the best companies in the sectors. I'll give you another example. What happened after 2001, the airline sector got absolutely hammered. So we bought KLM. KLM seemed to be arguably the best pick in the airline sector. And part of my simple logic was airlines are going to keep flying. We want to avoid the duds. People are going to want to fly more later on. And people in so-called third world countries like China and India, they're going to become wealthier and they're going to want to fly. Now, that was proven correct. So we paid $8 and change, ended up selling at $32 and change. So look for those beaten down sectors that have great potential to come back. And that's key. Again, you have to be wary of sectors, though, that will die. Coal, they were talking about dying when I worked in Czechoslovakia back in 1992. It's a while ago. Is it that long ago? I saw how they used coal. Coal was a necessity. Coal was a necessity here. So when I came back, I bought into a company called Luska. Coal is supposed to go the way of the dodo again. It's been phased out in many places, but it's not as easy said than done. And going all green, again, not as easy said as done. I mean, wind power is a great thing. Electrical is a great thing, but oil and gas has a place and will for a while. And the thing is, you can't get enough energy from some of these other sources yet. And people like to have their lights stay on. It's funny how people can be that way. They still like their television, their electricity, etc. They even need it for the electric vehicles. So sectoral analysis is important.
Yeah, absolutely. Thank you for sharing your commentary on that. Going back to banks, my understanding is that Santander is also one of your holdings right now. Can you detail your thesis on that, please?
Oh, well done. Yeah, this is a Spanish bank. Bought it about a year ago. It is one of the biggest banks in the world. It is the biggest bank in Spain. It pays a great dividend. They were paying a dividend, and then when there's the banking problems, pandemic problems, the European regulator said you can't pay a dividend. So they eliminated it. We paid $3 and change for the stock. Let me get the exact number because I know you want to know what it is. Banco Santander. So we paid $2.05. The initial sell target is $8.24. It traded at a much higher level than that. So I bought into one of the biggest European banks. That also, it's a huge bank in Brazil. It's in the United States and many other countries. So they had gotten a little sluggish in their approach. They weren't minding their knitting, so to speak. And I saw that a turnaround appeared to be in the cards. Now, the thing about turnarounds is there's nothing linear about them. What I mean by that is stocks don't go straight up or straight across. They may go down and up a bit. This is fun, follow the finger, and then often they fly. And that's what NRT that I just mentioned, that's what it's been doing. Bank America, that's what I did for a long time. It did nothing. But to go from $6 to $40, then it really started to move. Another thing that was fascinating about that one, when we bought it, they had cut their dividend to a penny a share every quarter. And I just thought, wow, if they turn around, and I don't assume anything, they'll raise their dividend. In the amount of time that I held it, they raised their dividend 4 or 5 times. So I was getting a much better return, especially better return on my initial investment. Santander is the same kind of idea. I suspect that their dividend is going to continue to go up over time. NRT that I mentioned, their dividend just jumped because of oil and gas prices. So companies that are beaten down, that eliminate their dividend, or knock it way down, if they return to form, as I like to say, you've got a chance of not only getting capital appreciation, but getting dividend appreciation. And that's what you call a win-win situation.
Yeah, absolutely. Thank you for that commentary. That's very insightful. Just into some questions about evaluating turnaround plays, specifically ones that are unprofitable. What are some signs that, an unprofitable company might successfully pull a turnaround and become profitable once again?
That's a great question. Because I go back 10 years, often I see the companies have been profitable for 7, 8 years, and they're not profitable now. So it indicates that they can be profitable. Company I looked at today, I won't mention the name because I'm still looking at it. I noticed that they used to be profitable. They haven't been for a few years, but their revenues are starting to really go up again. So if revenues are going up, it's generally easier, ceteris paribus, all things being equal, for the company to become profitable again. When companies' revenues are slashed, like they were in the oil and gas industry, it's tough to remain profitable. So again, I love looking at historical basis. I like hearing what management says, and often they'll give you clues that they will be profitable again. They may just actually state it. But again, remember to be cynical. But also, again, revenues going up, that's a big thing. Another way to look at it is if the company has been losing money, and maybe for a few years, if their losses are becoming less and less, that's an indicator that they're moving in the right direction. And often when companies move from red ink to black ink, that can really jump the stock price, sometimes much more than deserved, but it certainly does help. Ultimately, you need profitability to stay in business for a long time, unless you keep on getting people to throw money at your company when you're not. And we actually have been seeing that with a lot of the high-tech companies. They keep losing money, but people get excited about them, throw money at them, share price goes up. Of course, recently a lot of them have had their share price slammed, and for good reason, because the bloom has come off the rose in tech, where a lot of the valuations have been absolutely stupid. Excuse me using that word, but it's not so bad.
Yeah, absolutely. And so you previously said that there's an aspect of technical analysis in your selling process. Can you expand upon this thinking?
Well, within both the buying and the selling, we use technical analysis to a degree. As I said, we combine a lot of systems, and there's market timing. So I don't like buying a lot of stocks right now because markets are so high. To me, it's a good time if you're we're always selective. We always cherry pick. We always own not that many stocks. But when markets are high, it's a good time to buy less. When markets are really badly beaten down, it's a good time to buy more. I mean, I look at charts. I'm not a chartist. I know some people who just rely on technical analysis. I went out for lunch a number of years ago, actually it was for coffee, I want to be accurate here, with a guy who's considered to be one of Canada's great technicians. And I was saying, well, don't you look at anything else? He said, no. So people buy your system, they get like a one-trick pony. Yeah. But to me, that makes no sense. I want to look at many different things. I want to capitalize on the fact that stocks are in a momentum phase and sell at higher prices. I want to look, think maybe about breakouts and things like that. So I think technical analysis is a useful tool. It's like having a tool basket. You want to have multiple tools to look at things. And that's what we try and do. And in my books, that's something I discuss. By going into the other methodologies and taking what I think is worthwhile from those, I can build a better toolbox ultimately and have better results.
Yeah, absolutely. That makes a lot of sense. And a little bit of a flashback. So post-financial crisis, there was really 3 major banks in Ireland, and you bought Bank of Ireland out of those 3. What made for you Bank of Ireland a more convincing case than the other 2 banks?
Well, historically, they've done well. I like the CEO. Um, I looked at Ireland. Ireland people are very hardworking, and they're very technological in many ways. So it made tremendous sense to me. I had a 10 bagger on that one in a very, very short period of time. Again, a 10 baggers when the stock goes up 10 times. When I made the mistake, I was at Fairfax meeting. So Fairfax is a huge insurance company. Prem Watsa here, some people consider him to be the Canadian Warren Buffett. I don't, but they own a lot of companies, big holders of BlackBerry. They were kind enough to invite me to speak at one of their annual meetings. The company's done very well over time. And one of the guys there was the CEO of the Bank of Ireland. And the Bank of Ireland had hit the skids again. I should have just thought, okay, I'm going to invest in this one again. And unfortunately, I didn't. Now, I would have bought then at a couple dollars more than I paid the first time, but still would have had huge gains. So countries need financial systems. I know it's kind of like stating the obvious. Sometimes they have major, major problems. But one of the reasons I liked the Bank of Ireland was also it was the Bank of Ireland. You know, there's cachet with that. If it went under, that was a hit to the psyche of the Irish people. That's one of the reasons I like the Bank of America. If it had gone under, you know, what do American people think? Your Bank of America just went under. That would be ugly in many ways. So to me, that was a partial factor. When I was on television talking about Bank of America, I'd often mention that. It just made sense to me that they would want to keep it going. And another thing that happened then was the day after I announced that I'd bought into it, another guy announced it again, Warren Buffett in the States, that he had bought in. So if you see smart people who you respect in terms of investing, buying into companies, that can be worthwhile. And also it can be very worthwhile to talk with people you know who you think are smart investors and get their feedback, because they might see things in companies that you do not see, positive or negative. And getting additional input is very worthwhile. I kind of segue a little bit, but that can be worthwhile.
Yes, it's excellent. Thank you. And for concluding questions, one, are there any additional theses for stocks you would like to share with us? And two, what are the most influential events in your investments career?
You know, I think often a good thing to do is start with paper trades if you haven't made investments. Try techniques, see how you do with them, see if they work, and then, you know, go in one toe at a time. I think that's critical. And then gradually invest more. My eldest son, he started investing, and he doesn't invest too much in anything. He continues to learn, he continues to read. I think that's very important. And just, there's two things you learn from. One is you learn from what you do right, and that's great. You also learn more, I think, from what you do wrong. Learn from your mistakes. And I know some people who hate admitting that they make mistakes. And when I was younger, about your age, I didn't like to say I made mistakes. Now I say I make mistakes very often. Sometimes, and this may sound kind of silly, if I'm in a discussion with someone and they get very, offensive about it, I may say, even though I know I'm right, I may say, okay, you're right. It's just not worth it to me to fight these things out. When I talked about efficient market hypothesis with my professor, an older student, I was 23, he was 28, but he'd worked out in the field. He said, why do you bother to argue with the professor? And I say, because I'm right here. It's important. If I was in the class now, I might just let a sleeping dog lie and move on. Is that correct to do? I'm not sure. But learn from your mistakes. Don't be afraid to admit them.
Excellent. Thank you so much. This is a phenomenal session, and we really appreciate you taking the time out of your busy schedule to speak with us today.
It's been an absolute pleasure. As I said, I'd love to get out to some more universities in person. And maybe one day I will get to Rhode Island and we'll sit down and break bread together.
Excellent. That sounds great. Thank you so much. Have a great day.
You too. Pleasure.